afternoon, ladies and gentlemen. Of course, I want to say good afternoon to those of you who are joining me here from the East Coast. Also probably want to say well, I should say good afternoon. My apologies. For those of you joining me here on the East Coast just after 12 noon Eastern Time, good morning to those of you in the Central Time Zones, the Mountain Time Zones, and the Pacific Time Zones, of course. And good evening to any of you who are joining us from across the pond in parts of UK or parts of Europe, and good early morning if any of you are awake and joining us from parts of Australia or Asia. Welcome to today's presentation, the criteria for calendar spreads. We're going to take a look into the spread and stock criteria for horizontal and diagonal spreads. For those of you who don't know me, of course, my name is Mike Chepka. I'm the Director of Education here at Power Options. I'm going to encourage you, of course, to send any questions that you have at any time during the webinar about the material that's being presented. And just keep in mind, a lot of the material that we're going to, questions you might have, excuse me, are going to be covered in the presentation. But remember, just send in those questions at any time. I don't have really any polls set up for you because we want to cover a lot of information today. So anytime you feel the need, you need some clarification, or you feel that I didn't explain something very well, use that question pod inside the GoToMeeting, GoToWebinar platform to send me your question, and I'll clarify the point that we are making or the criteria that we are reviewing. All right, now for today's discussion, we're going to look over the criteria and set up for diagonals and horizontal spreads. Question just came in. Jim said, will you cover double diagonals? No, we're actually not going to cover double diagonals. We're going to talk about the horizontal and the diagonal spreads, directional and neutral. We'll save the double diagonals discussion for a later date. Okay. All right. Now we're going to go over a recap of last week's introduction to the spread positions, the calendar spread positions. We're going to look at trade direction, stock criteria to match sentiment of a spread. We're going to talk about the proper structure based on expectations and goals for the spreads. And then we're going to look at a little bit of the horizontal comparisons, okay? Okay, and Bill, Bill joined us for the last presentation. Of course, he's joining us for today's presentation. And Bill said, I would be most appreciative of any tips on how to minimize rollover to a later month. Well, you've probably seen how we're setting up these webinars, okay? Anytime I set up a strategy session, we do an introduction, we discuss the criteria, and then we discuss management. With all things going the way we want to, Bill, the management discussion, tips on adjusting and rolling a spread will be conducted next week. We're not going to go into adjustments in management today. We're going to talk about the setup and the structure for the criteria today. Okay? All right. Now, let's talk about a review of horizontal spreads. Some of you may just call them calendars, but in last week's presentation, we broke down the definitions. Okay? Our definitions, a calendar spread is any combination of selling a call and buying a call, or selling a put and buying a put, where you have two different expirations. We talked about reversals, we talked about the standard, and then they're broken down into two structures. A horizontal spread means you're doing the same strike. Okay, so I'm selling a near-term call, let's say a 50 strike, and I'm buying a 2-month out, 3-month out, or 4-month out call at the same strike. That's a horizontal. They're both calendar spreads, but this is referred to as a horizontal. The diagonal is when I'm going to buy an option far out in time that's deeper in the money and sell an option near term that's at or slightly out of the money. Okay? In either situation, you can use weeklies, you can use standard monthlies. So, a horizontal, sell a call near term, buy a call farther out in time at the same strike. It is a neutral position, but it can be biased. And we'll talk about that later. Because you're buying typically an at-the-money option that's 2 or 3 months out and selling an at-the-money option, you get a very high leveraged return. Your net debit is usually pretty low. So you have a low cost in the position, but again, it is a very neutral position. You don't want the stock to move more than maybe 2% up or down during the time frame you're in the horizontal trade. Horizontal put is the same thing. We sell a near-term put, typically at, just out, or just in the money. Buy a further out option, maybe 2 months out, maybe 3 months out, maybe just 1 month out. okay, at the same strike price. Again, neutral position, if you swing that same strike spread deeper in the money or deeper out of the money, you're going to be biased towards a market sentiment of bullish or bearish. Again, high leverage, low cost. Okay, so a couple days ago, 17th of March expiration for this expiration date. A couple days ago, looking at Apple at 138.50. A diagonal call on the right-hand side, we might sell the March 17th 140 call for 60 cents, and you might buy a far out, 16th of June, or you could even buy in April. But in this example, we're looking at a side-by-side comparison. If I bought the June 140 call for 490, we have a debit of 430 with a chance to make 26% maximum return at Friday's expiration. Well, the key is that that return is based on the remaining long call value that we would have. Okay, we talked last week on the horizontals. You want to avoid early assignment or assignment if possible because it's the same strike. If I got assigned early, Apple gaps up to 150, my broker forces me to buy shares at 140 and sell it at 140, I make nothing back. Okay, I'm out 430. Want to make sure that we're in a position on a horizontal where we're always selling to close that long option if possible and avoiding assignment if possible. Now, the calendar put spread is on the right-hand side. Now we're looking at a slightly in-the-money put here. It's at the money, but we're looking at the 140 strike for the 17th of March expiration. And we could receive 205 for that position. Okay? But with the stock at 138.50, we're $1.50 in the money. Okay, so we're receiving about 55 cents of time premium against a debit of 660 because our long put is also slightly in the money. But the risk-reward profiles are similar. One offers the potential for a 26 maximum profit, 26%, the other at 25%. These are really parity trades of one another, a horizontal call spread and a horizontal put spread. You get the same risk-reward profile, you get a similar return on the position. Okay? But you'd want to decide based on which gives you the best bang for the buck, for lack of a better term. The calendar call, the calendar put would match your goals. And of course, you'd be doing this only on a stock that you feel is neutral and is not going to move. Okay, but we see that a 4 or 5 day trade, we get a good leverage return even with weeklies. And we only received 60 cents a time premium for the 140 call for a 4 or 5 day trade, and we would have only received 55 cents of time premium on the put against the debit. But the goal is, it's usually a one and done trade. When we hit expiration on Friday, we want the stock to be as close to our option strike price as possible to get near the peak of that profit and loss chart. Of course, it can be managed, but most investors who do the standard horizontal are looking to get out of it in that shortest term time frame. Maybe a 1 month out, maybe a 2 month out, or I'm sorry, 1 month out, maybe a 2 week out, or maybe a 1 week out as well. Some of the concerns about your horizontals, it gives you 2 ways to lose. It is a very neutral position, just like an iron butterfly, a short straddle. We saw that on the graphs. We want the stock to be right at that price. It is a debit transaction, so no margin is required. And the return is theoretical, remember, it's not guaranteed. The returns you see are based on the expected value. Let's go back one. This return here on March 17th for both the horizontal call and our horizontal put are based on the theoretical value of the long June option if our stock was trading right at 140 at the near-term expiration. Okay, we don't get any leeway here for being assigned early because we used a same strike spread, a horizontal. Okay, so it gives us that tent, or that sort of A profit and loss chart. It's a very neutral position, and we do have 2 ways to lose. You see in both cases, the upper and lower break-evens are about a 5-point spread, 137 to 142, and about the same here, just a few cents off of one another. Okay, so when doing the horizontals, we're going to want to look for positions that match that sentiment. Let's talk about our brief review of the diagonals. In general, diagonal call spread, we would sell a near term at or out of the money call, and then we typically buy an in the money call further out in time. Now this is going to result in a higher debit. We're paying more for the option that's in the money, but we're looking to have a better delta, and this also changes the structure of the trade to where we're neutral to bullish or neutral to bearish, depending if we're a diagonal call or a diagonal put. One of the advantages of a diagonal over a horizontal, of course, is it just gives us one way to lose. Diagonal call is neutral to bullish, so if the stock falls, we can lose to the downside. Diagonal put would be a similar structure. We'd sell the near term at or out of the money put, buy an in the money put, a higher strike price for the put, further out in time. Higher debit, but it's neutral to bearish. We only have one way to lose if set up properly, and that's going to be to the upside. Okay? Santosh says, how do we calculate the break-evens of a calendar spread? Well, we do that for you on power options in the calendar search, whether you're looking at horizontal or diagonals. We're running the theoretical pricing models to calculate what that long option would be worth if the stock was trading at the max return. Okay, let me go to the next profit and loss chart, Santosh. Here would be our diagonal spread on Apple, still at 138.50. Now we could sell the near-term 140 or 139 call. In this case, we went right at the money with the 139 for $1, but we buy the June 130 call. So we get a higher net debit into the position, which does mean a higher risk as opposed to the horizontal. But we only have one break even to the downside at about 135. If the stock continues to move up, if it gaps up to 150 or 160, we're still making a profit. And that's because the proper structure that we're going to look at in just a moment. On the put side is a very similar thing. I'd sell the slightly out of the money put, which would be the 138 for about the same dollar premium, and maybe buy a 145 for 850. So again, we get a profit and loss chart where the max return is right at the short option strike price. And this is what you see with any horizontal or diagonal. That is the max profit. It is where you wouldn't have to pay anything to buy to close the short option, or even if it expires, but the long option would have the max theoretical value against any buyback cost on the position for the short options. Okay? So, diagonals in general still give you a good leverage return, even using weekly series. Some investors treat the diagonal spread as a way to mimic a covered call or a covered put. Why buy Apple at 138.50 and sell the 139 call when I can buy an in-the-money 130 call for $9 or $950 for one contract instead of spending $13,850 for 100 shares? Set up correctly on the diagonal, there's only one way to lose based on the market sentiment if you do a calendar call or a calendar put, whether you're neutral to bullish or neutral to bearish. The diagonals, buying in the money to have more downside protection in the sense, to keep more of your long option value if the stock falls or the stock moves up in price. Many investors would continue to trade cycle by cycle. And again, the return is theoretical, but in a diagonal you can set up a guaranteed return. Okay, so we're 15 minutes in. That was pretty simple. Just a review of the diagonals and the horizontals. Why did we take an hour to review that last week? Well, because the devil's in the details. We needed to further review the pros and cons of both. We needed to illustrate the importance of proper structure and avoiding early assignment or assignment on the diagonals or the horizontals. And then we had to review the specific terms for each strategy that might be new to investors. Okay? And some of those terms were the right cycles. And the right cycles refers to the number of times you can sell the short option against the long. The delta ratio. For diagonals, we look at the delta of the long option that you're buying divided by the delta of the short. You want to have a reasonable delta ratio so that if the stock does move up 1 or 2 points, you're gaining a larger percentage on your long option than you're losing to potentially liquidate or buy back the short option. In diagonals, we talk about the difference in strike ratio. Now what this means is that when I buy a diagonal spread, I'm buying an in-the-money option and selling the near-term option. The option I'm buying is in the money. I want the net debit of the position to be less than the difference in strike prices. So if the unexpected happens and my diagonal call, the stock gaps up, and I'm forced to be assigned early on the position, I can still have a guaranteed profit. Okay? In that situation, if the stock falls, I might still have a loss, but you can guarantee a profit to the upside with the proper structure. And whether you're doing the horizontals, more so to the horizontals than the diagonals, but we talked about the implied volatility ratio. A main component of doing the horizontal, the same strike spreads, is that you want a quick implied volatility decay in the short term, and you want your implied volatility of the long option to not decay much at all. Okay? That's sort of the game that you're playing, so we always want an IV ratio of greater than 1, where the implied volatility of the option we're selling is typically greater than the option that we're buying. All right? But terms, criteria, the underlying, it's all a lot of information. But even if we set up the right number of right cycles, we have the delta ratio we want. Even if you use gamma ratio, which is something I personally don't look at, and the IV ratio, let's be honest, whether you're doing horizontal or diagonals, you're not going to make a profit unless the underlying moves, or doesn't move, matching the sentiment for your strategy. If you pick a significant bull or bear for a horizontal, the same strike spread, you go deeper in the money or deeper out of the money, you go to sentiment, you could typically lose on the trade if there's no significant movement on the position, regardless of the return that's listed. Okay? Now, before we get to the structure of the spreads and what we might look for, let's talk about typical bullish and bearish criteria that investors might use for the underlying. Okay? These would apply to our diagonal call, neutral to bullish, or diagonal put spreads, neutral to bearish. Okay? All right. So let's talk first, about the diagonal call spreads. With the standard position, we already saw this, but we're going to sell a near-term at or out of the money call. And we want to buy in the money further out in time. And in general, we want to look for at least 3 right cycles. Now what does that mean? That means that if you want to do weeklies, you wanted to enter a trade on Monday with the option that expires 5 days out in time, the farther out option that you're buying that's slightly in the money, with a calendar call, a diagonal call, or a diagonal put, you would want that to be maybe at least 25, 21, or possibly 30 days out in time to give you a fair amount of right cycles, at least 3 in between. If I'm doing the static monthlies and come Friday I decide to sell an April option, I'd probably go out 3 months minimum. Okay, so I'd go out April, May, June. I'd be looking at the July possibly, or the August series, so that I have a minimum of at least 3 right cycles if I'm just doing the standard monthly positions. Okay? Now it is neutral to bullish with a diagonal call. Although calendar spreads, diagonals or horizontals, are leveraged, the advantage is we can use less money to get into the position, and some say mimic a covered call with a diagonal spread, or you're looking to mimic a short strangle with a horizontal spread. The same underlying criteria that you would use for those similar strategies are what you'd want to look for. So in a diagonal call spread, we want a neutral to bullish position. I would look for the same underlying criteria that I would use to get into a covered call or an out-of-the-money naked put position, what's called a covered combination, combining a covered call with a naked put. A standard collar, the same criteria I would use for the other leverage spreads, the bull put credit or the bull call debit spread. Okay? So what do we typically look for fundamentally on a stock that we want to be neutral to bullish, that we think might grow or at least be stable for the next 10 days, 20 days, or even 30 to 40 days out in time? Well, we want to look for stocks with good liquidity. We want to look for mid to large cap stocks, and we want to see a good average volume on the position. I don't really want any fly-by-night companies. With leverage spreads, even though the volatility of the stock might be higher, which would lead to a higher implied volatility on the near-term options, I don't necessarily want a small cap stock that tends to fluctuate 5 to 10% over a 15, 20, or 30-day period. They can give you a good return, but I want something more neutral or stable for both my diagonal spreads and my horizontal. Now for a diagonal spread, neutral to bullish, a diagonal call spread, I'm also going to look for stocks that have shown good management. Okay, we're going to look for stocks that have shown earnings and growth, have grown in earnings over the last year by at least 5% or more. We also, with the different searches that Ernie has done and the testing that Ernie and I have done over the time for different strategies, we want to keep the stock with a relative PE ratio, price to earnings ratio, somewhere 0 to 70 or 0 to 50. With any leverage spread, whether it's a calendar, a horizontal or diagonal, standard vertical spread, we want to avoid stocks that have an earnings date between now and the short-term expiration. In my opinion, this is extremely important for the horizontal spreads, and we'll show an example of that at the very end of the presentation. Because we're using leverage, stock price is not really a factor, is it? We saw that we could take advantage of Apple trading at $138.50 by only spending maybe $7 or $8 or $5 or $6 to get into a diagonal spread or horizontal. We could probably trade Priceline with a cost of maybe $40 per contract. Okay, so we can take advantage of the larger price stocks. You would have to determine, of course, where you'd set your net debit for the position as a maximum, meaning that if you don't want to trade spreads that have a net debit greater than $20 or $15, that's something that you'd want to set and filter out as well. Now, that's just fundamentally what we want to see in the stock. We want a stock that has reflected good growth in earnings. We want a stock that has a good volume and a good liquidity. Okay? We don't want to see sudden changes where it could drop 10% on low volume or gap up 15% because of sudden influx of volume either. Okay? But when we talk about the technicals, yeah, we want to see stocks in an uptrend. It's dangerous in a lot of cases to bottom feed with horizontal and diagonals unless they're stable. If you have a stock that's just been falling and falling and falling, you might be a good idea. It might be a possibility for a calendar put spread, a stock that's been declining. But if it looks like that trend is going to continue, I don't want to do a horizontal against it. You need the stock to be stable over the time period of the short option. So when we're talking about neutral to bullish, the indicators we prefer, we want to look for stocks that are trending above the 20-day or 50-day moving average. We want to see stocks that are probably near the upper range of the upper Bollinger Band. Okay, the Bollinger Band, of course, is an envelope almost around the stock price reflecting 14, 15-day trends. Okay, you have an upper band and a lower band. Stocks that are near the lower band, of course, have been in a decline. Stocks that are near the upper band have been pushing up and either moving the band up or potentially poised for a breakout. MACD. A simple crossover line for a MACD position. We want to look for positions where the MACD would be above the signal line. And then, of course, others you could use, broker recommendation and average volume. Okay. Now, why focus on these criteria? Well, I don't want to delve into 1,000 different things that we all know we can talk about. Okay, many of you might use things such as the Williams percent R, slow or fast stochastic. The idea is whatever works for you, whatever you've been using in the past that has led you to successful selection, being right more than 65% or so of the time, selecting bullish positions or selecting bearish positions, you would still continue that with the other structure for the spreads we're going to look at in a moment. But at the same time, if you're struggling with that, these are the criteria that Ernie and I have found for the neutral to bullish positions that seem to give those better results we're looking for, showing neutral to bullish positions about 70, 65% of the time. And of course, the positions that lose, that's where the management comes in. This type of criteria I just reviewed is a similar criteria that Ernie found after extensive testing worked best for identifying covered calls and naked put positions with a better success rate for the picks of the day strategy and power options. Yes, they're different strategies, but it all comes down to a similar sentiment. We're all neutral to bullish. Covered calls, naked puts, standard collars, bull put credit spreads. We want to match that same criteria that we would use for those spreads, and those strategies, to match what we want to see in our neutral to bullish diagonal call or the neutral to bearish in the diagonal put. All right. Now, those are some of the stock criteria, and we'll talk about that a little bit more. But now let's talk about the structure of a true calendar diagonal, call or put. Last webinar, we talked about weeklies versus monthlies, what to expect, and what structures we would look for. We know that when we're creating that diagonal spread, maybe you're doing it to mimic a covered call, maybe you're doing it for the leveraged return. Both are proper approaches. But the basics we want to look for is we want that FAR option generally to be in the money. Last week we did talk about reversals for the lower debit, and the question that came in earlier about the double diagonals is I might sell an at the money call and buy an out of the money call further out in time for the lower debit. But that creates a bearish position similar to a calendar put. We talked about the parity there last week as well. All right. But I want the option I'm buying to be slightly in the money. And I want the near-term option to be at to maximize the time value or out of the money. Now we talked about the IV ratio and looking for positions where our implied volatility of the option we're selling, we want it to be equal to or higher than the implied volatility of the option that we're buying. And in a diagonal call or diagonal put, the delta ratio is very important. I don't use delta ratio when I'm doing vertical spreads or in my collar positions, for example. But when we're talking about calendars on a neutral to bullish or neutral to bearish position, I do want to see a delta ratio where the long call is going to gain more than the short for a 1-point movement. Okay? So we want our delta ratio to be around 1.5, greater than 1.5 or 1.6. So if the stock gains 1 point, our long option in theory will gain 50 to 60% more than we might be giving back on the short option as we evaluate liquidation. Now, of course, I put an asterisk next to this position, next to this statement, and the reason why is what we have to remember, that if I'm in a diagonal spread and we're at expiration, if my short option is in the money, I have to remember that the delta of the short option goes magically to 1, where the delta of my long might still only be 0.8 or 0.6. So at expiration, the moment of expiration, of course, or getting close to it, the short option delta tends to get closer to 1. Naturally, if it's below it, it would expire, and if it's above it, well, if it's 1 point above our short option, it would be worth $1, have a delta of 1. Okay? But when we start the position, we want a delta ratio, a strong delta ratio for our diagonals. Now, some of you are doing weeklies, and some of you are doing monthlies. And we're going to take a look at weeklies for the diagonal call spread. What would I look for on the structure of the spread position? Well, on the expiration time frame, naturally I'd look for my short option to be between 0 to 7 days out in time. I want to keep those right cycles at a minimum of 3. So my long call or my long put on a diagonal, I'm going to look for that to be at least 30 to 60 days out in time. Now, when you're looking at the structure, you want to be at or slightly out of the money with the short option. So we probably don't want to go more than 3 or 4%. When using weeklies, you probably don't want to go more than 3%. You could find positions that were 8 days out in time that were 5% out of the money if you're looking for that call to expire and you didn't want to manage it. But that option might only have a premium of 5 or 10 cents. Okay? You want to keep that closer in to the at the money range so you get a better premium against the position. And the long option that's going 30 to 60 days out, we probably want to be about 4% or more in the money. But we still want to match our other goals. We want that IV ratio of greater than 1. And typically we look for a delta ratio of greater than 1.6. So if the stock moves up 1 point, we see a gain on our long option that at the start is 60% higher than what we're losing on the short option. So remember, if you have to liquidate, you're going to have to buy back the short. Okay? Now, talk about two other things here, the return and the premium. There's a term we like to use, and it's many of you know it for covered calls. It's called downside protection. And on a covered call, the downside protection reflects the option premium you're receiving divided by the underlying stock price. It shows you how far the stock can fall before you're losing money on the position. With a diagonal spread, we're going to be able to increase that a little bit more. Because what the downside protection reflects in a diagonal spread is the option premium you're receiving against the cost of the long option. So if I'm only going 4 or 5 days out in time on a covered call, I might look for a downside protection of about 1%, maybe 1.5%. But I can triple that, almost quadruple that easily because of the leverage. I'm not paying for the stock. I'm paying a fraction of the cost for the stock by buying that in the money long option. So we're going to look for a minimum downside protection of greater than 4 or 5%. And of course, where in a covered call, I might look for a weekly return of around 0.4 or 0.5%. Again, we can double or triple that, maybe even quadruple that at the opening to look for a minimum return. Okay, now these are starting points. We're going to talk about that a little bit more, but these are the starting points of what you'd want to look for compared to maybe what you have been looking at for weekly covered calls or other positions. Now, I mentioned a 15-cent premium. Well, that's just a minimum requirement personally. Actually, mine's probably higher than about 25, 30 cents for the option premium that you're selling. Okay, just the short option bid by itself. Okay, but what's probably more important to you is the net debit, the total cost of what you're paying minus what you're receiving for the short option. But remember, the most important in the diagonal spread, yes, we want to have stocks that move in our direction, but the most important is to have a net debit that is less than the difference in strike prices. Okay? We want the total cost of what we pay in the position to be lower than those strikes. If the stock gaps up and we get assigned, on the Apple position, if I had sold the 139 call for Friday's expiration and I bought the 130 for June, I want that debit to be less than $9. So if the stock gaps up in price, I can get out at a profit. Because if you do it where the debit is greater than the difference in strike prices and you're assigned early from an unexpected event, you come out of the position with a loss. And again, here's another example for Alta that was seen this morning on one of our criteria searches that we're going to talk about in just a moment. Okay? But here's a spread on Alta, currently at 286.19. If I was opening a weekly spread, earlier this morning we could have sold to open the 17th of March, 290. Okay, so a little bit of breath out of the money, less than 3%. And this is our short option right at 290. And at the same time I could buy an April 21st. It's 37 days out. This gives me more than 3 right cycles, of course. And we're buying the 275 option 37 days out for a price of $14.30. Now, although this looks expensive, keep in mind that this is 11 points in the money. So of this $14.30, we're paying $3 worth of time premium for 37 days. We're getting 35 cents of time value for 2 days. Okay? But the net debit of this transaction is $13.95, which means that if for whatever reason, of course we're going to skip earnings, Alta does not have earnings coming out between now and Friday's expiration. But if the stock suddenly gaps up to 300 or 305 tomorrow morning, overnight, and we get assigned early at this 290, remember, I don't own the stock. So what my broker would likely do is look at my account. So he doesn't own the stock, but he's got the right to buy shares of stock at 275. So they'd exercise my long option to deliver the obligation at 290, and I'd get out at $15 between the two. Okay, so I buy at 275, sell at 290, early assignment. my cost basis was only $13.95. So in that scenario, we're guaranteed to get a profit of $105. Now the max return is way above that. You know, it's above about 280, it's about 281, 290 here. Why? Because in that first month, that first week, if Alta goes right to 290, this option is going to be worth more. My 275 is going to be worth more than 13.95. That 13.95 is the worst case scenario to the upside, getting the $15 back for the 105 profit. Now if the stock hits this point, I might be able to sell that 275 for maybe, let's say 16, maybe 16.50, so we're going to get closer to that profit of 280 or 290. So it'll be about 16.50, 16.70. We'll get closer to that profit as well. Anne asks a question, would a cheaper stock be more profitable, like STM? Okay, well there's a trade-off. What's the trade-off? Okay, let's think about it this way. Alta is at 286.16. And I'll take a look at an example at STM for you, Anne, later on in the webinar when we get through our other material. But let's just think about the math on this in general, okay? Alta right now is at 286.16. We've got a debit of $13.95, making 35 cents against a 14.30 with a max return of about 281. If I took a similar stock with a similar volatility, stock trend, of a stock trading at 28.61, okay, well, what we might do in this case is be buying the 27.50 call for April, which, let's be honest, might cost us $1.45. And at the same time, I'd be selling 2-day out 29 call. But again, what's the price difference? Although this is at the money, we're looking at a lower price stock. Here we are at 14.30, so I might only be buying this for 145, a factor of 10. But that also means the option premium I'm selling might be a factor of 10. We might only get 4 cents or 5 cents, not 40, 4 cents or 5 cents. So I drop my debit down to, let's call it $1.40. And we've got a 27.50 and a 29, so the value between is 150. Okay, so if the stock gaps up and I'm assigned early, I make 10 cents against $1.40. Okay, very similar to making the 105 against a debit of $13.95. You know, we're pretty close. Percentage-wise, it would be about the same. So what's the advantage? Well, I paid $1.40 per contract instead of $14.30. Percentage return-wise, though, you're looking at the same, because although this is a factor of 10 lower, this call is probably a factor of 10 lower as well. And a 10-cent net credit against a $1.40 debit, or the max return would probably be the same. I'll try to find a stock at 28.61 for us when we go to the end there, Ann. But that's what you'd expect to see. Is percentage-wise, we'd be close to the same. Guaranteed profit if it gaps up, we'd expect to be the same if we're assigned early, percentage-wise. Monetarily, it's going to be different. But if you're only trading 2 or 3 contracts, remember a profit of 30 cents trading 3 contracts, you might give up half of that to commissions, depending. Okay, so that's something to consider. Will certain lower stocks have a higher percentage return because of lower net debit if they're more volatile? Sure. But again, if you compare a $280 stock to a $28 stock and they have relative similar volatility, historical stock volatility and implied volatility, yes, you're paying a factor of 10 less for the position, but your monetary profit would also be a factor of 10 less. The percentages would come out the same, assuming all are right. Okay, so that's why we want the net debit to difference in strike price to be a little bit different. Real quick, let's review. What did I just go through? I know it was a lot of terms I threw at you and things of that nature. But when looking for a diagonal spread using weeklies, what did we want to see? Okay, well, again, I want to see stocks that are mid to large cap that don't show a lot of fluctuation and a lot of historical stock volatility. Yes, that might lead to a higher implied volatility and a higher return. I want stocks that have shown good growth, have a relative PE, and I want to avoid stocks that have an earnings between now and expiration. At the same time, technically, yeah, I'm a neutral to bullish position for the diagonal call. So I want stocks that are trending above their 20-day or 50-day moving average. And of course, we talked about stocks being near the Bollinger Band and the MACD. And of course, you might use that average volume filter as well. Now that's for the underlying stock. Most of what you'd look for in standard neutral to bullish positions. And then for the structure of the trade, if you want to use weeklies, set your short option to be 0 to 8 days out. You want your long option to have at least 3 right cycles. You want to give your short options, there's nothing wrong with trading the at-the-money strike for your short option if you're more neutral on the position than slightly bullish. But if you're neutral to bullish, you want some breadth to the upside, maybe at least 3%, 2% out of the money to allow for some growth over that shorter term period. And you want to give yourself some cushion to the downside. You want that long to be at least 4% in the money. The IV ratio, we want that to be greater than 1. And we talked about the delta ratio being greater than 1.6 and the standard of downside protection. Okay? I don't like to use the term the proof is in the pudding, but what are we talking about here? Here's a look. Now, I did extensive testing on this over the past few weeks. Okay, different structures, different setups, and I started with the base point of what Ernie and I would use for any neutral bullish position. Going back about a year, we took the basic structure of that criteria first. And what we saw is that looking for positions that matched that criteria for the weekly diagonals, if we started on March 1st, we would have had taking the top 15 historical trades that matched that criteria. There are 85 total, but take the top 15 as far as return and downside protection go. 60% of those were successful, but the average return for the 15 positions is only 1.5%. The largest gain was leverage, as we'd expect, at 28.60, and the largest loss was at 45%. So it's not a good month, or not a good week. At expiration on 3/7, the Monday following expiration on 3/4, there was 144 results, taking the top 15 another 60% rate, but is only 1.9% average return of the 15 positions. Largest gain again, very respectable for a 5-day trade, 28.3%, but then the largest loss was more than that. Then things get worse. Go to the next week, top 15, only 47% success rate and a loss of 5.5%. And what does this mean? Well, if I took the same amount of money, let's say $10,000, to open these 15 trades, you know, the average return we see a 1.5 gain in week 1, a 1.9 in week 2, and in week 3 a loss of 5.5%. Okay, so we're behind, and then the 4th week we get slaughtered. Only 17%, 1 out of 6 were successful. Okay, the average return was minus 21%. So we've taken our portfolio down by about 22, 23%, assuming average money allotted to whether the 7 positions or the top 15 positions over that time. And of course, you can see the leverage here destroys it. It works in our favor with the 28% gains, but it also works against us. You have a 10% drop in the stock, you might lose 30 to 40% on the long option. You see a 20% drop in the stock, we're talking about a 50 to 60%, maybe even a 70% loss as we see here. Okay, now, I did that with the structure criteria for the calendar spread I mentioned. Doesn't mean the structure is wrong. This first result that we're seeing was done using our fundamental data we suggested, but not the technical data for the MACD and the Bollinger Band range. So we take the same criteria that we used, looking for stocks with good earnings per share growth, mid to large cap, not having earnings, of course, between now and expiration, and the structure we wanted, and now we apply it with the MACD and the Bollinger Band. So we look for stocks, that are near that upper Bollinger Band, that are showing growth, and have had a recent crossover. And what do we see? Well, you only get a limited number of positions, but in that first week, we had 2 results. 1 out of 2 was successful, but the average return was 1.5%, similar to what we saw week 1 with the first trade. And then the second one, you only had 1 result, but it resulted in a 15.8% return. In the following week, 314, again, only 1 trade, you end up with a gain of 16.5. And then going to 321, there was only 2. Now, this is a negative, I apologize, but the average return was a minus 7.6%. But again, with even money, with adding just the Bollinger Band and the MACD crossover, we're looking at a positive portfolio over 4 weeks as opposed to a negative portfolio, where you might be down as much as about 22, 23% of what you started with. The first week was even, but then the consecutive weeks, of course, panned out better by simply adding the MACD and the Bollinger Band into the range. Now, another thing to look at here, we saw some of these losses near 30%, 50%, and 68%, probably because the stock dropped 20 or 30%. Yes, we have a 25% loss in that first selection. That is true. But at the same time, down here, and this was a negative, I do apologize, this was a negative 16.4%. But let's think about that. If my debit was $5 or $7 into the spread, what's a 17% loss? Well, it's about $1 if I had a $7 debit or so, right? That's looking at about 17%. So when you're thinking about a calendar spread, if I'm out 3 or 4 months and the stock fell to where I paid $7 in the position, my short option expires worthless, and my long option is down to $6, that's not too hard to manage. That's why we want it to be 3 to 4 right cycles out, because not every position is going to be beneficial. Yes, this 25% loss up front would be harder to manage, but we still ended up with a positive return when we added the MACD and the Bollinger Band. And this 16% loss is probably manageable with the proper structure of giving ourselves at least 3 right cycles going forward. Now, I'm not going to go through every cycle with you for comparing that standard search with just the stock fundamentals and the structure that we want versus using the Bollinger Band and MACD crossover, but we're going to look at one more recent one. A similar search, that same exact structure for the diagonal spread that we reviewed. January 23rd, 2017, that search with the fundamentals, looking for a good earnings per share growth, no earnings between now and expiration, PE ratio 0 to 50, okay, and mid to large cap stocks, but without the Bollinger Bands and MACD, there were 4 results that matched the criteria. Only 50% were successful, 2 out of 4, and the average return was a loss of 2.7%. Now, the biggest gain of the 2 winners was 8.6%, and the largest loss was 12.3%. Again, it could be managed. But applying the Bollinger Band and the MACD took out the 12.3% loss and the other 1.6% loss. There was only 1 result. It's the same one that was in the other search for an 8.6% return. Okay, so is less more or more less? Well, this is the same experience Ernie had when he was developing the picks of the day for the cover call and for the naked put screen. Adding the technicals will give us less results week by week. Okay, sometimes there'll be no trades that match the criteria. However, the overall return was much higher over a 12 and 15-month time horizon than it was without including the MACD crossover in the last 2 or 3 days and stocks near the upper range of their Bollinger Band. Okay, so it's balance. And then what happens to a portfolio if you add more positions? Okay, well, if we add more positions into a portfolio, what do we know? You still might have positive leverage gains in that 28 to 30% range, as we saw with the first screen going through March 2016. But then you're also going to have losses. And a lot of times those losses might be a little bit more. So the overall winning factor of your portfolio is lessened because of diversification. Are the losses lessened? Yeah. If I just did 2 trades and one had a 28% gain and one had a 60% loss, I'm going to be down about 40% on my portfolio, of course. If I had 10 positions and 28 was the highest win and 60% loss was the largest loss, but I was right 60 to 70% of the time, that loss would be less reflective, but then the winning 28% would not increase my portfolio as much as more. Okay, so a debate on the structure is more than welcome. What I'm just showing you is what we tried to find and what we did find, following the same thing that has worked before with other strategies with the same sentiment for diagonal calls and neutral to bullish positions. Okay, so let's talk about the weeklies. Okay, when this was just with the weeklies, you're looking for a short option that was, 5 days, 7 days out in time. But that long option, you want to be 30 to 60 days out or more in that range to give you that 3 right cycles. We still want an IV ratio of greater than 1. You want a delta ratio of greater than 1.6 on the diagonal. The downside you can absolutely increase, but you want at least a 4% downside protection. And of course, for the shorter term, we look at 1.5%. And most importantly, the debit to strike difference ratio of less than 1. I had mentioned a premium of at least 15 cents. That's what I used in the testing. But most of the positions that came up were in a higher range, 20 cents or 30 cents. That's a personal preference based on how many contracts you plan on trading and how much your commissions affect it. If you're going to only open 3 positions in a portfolio perhaps, and your commissions are, let's say, $8, we know that everyone's dropped them like a floodgate over the last week, where one brokerage house came out and said they were dropping their commissions down to $4.95 for options, and then slowly everyone else did. It was a planned thing. I guess everyone knew what everyone else was doing. But, okay, so you're opening 3 positions, you're only trading 1 or 2 contracts, and your commissions are $9 or $9.50. You probably want more than 15 cents minimum net credit so that the option premium doesn't take out, or I'm sorry, the commission doesn't take out 25, 30% of your total premium. Okay, and liquidity, to tell you the truth, most options that you're looking at for the short sell that are 0 to 8 days out in time are going to have good volume and good open interest. Okay, very few would have a 0 open interest and no volume today. And the long option might be a lower one, but it's still probably going to have a higher open interest and maybe even a higher volume today than the number of contracts you're planning on trading. Okay. Diagonal call, again, the fundamentals, an earnings per share growth of greater than 5%, PE of 0 to 5, or 0 to 50. You want mid-cap stocks that have good average stock volume. And of course, we want to avoid earnings. Why take the surprise? We saw in those first results from March a loss of 68%. Now that wasn't a stock that had earnings, but we know because of the lie of leverage, if your stock suddenly gaps down 15 or 20% for poor earnings, regardless of what the return was, the value of your long option in a diagonal or a horizontal is going to drop 40 to 50%. That's your loss right now. How long would it take you to make that back, even if you had 5 to 10 or 5 to 7 right cycles? How are you going to make back that 50% if you're only generating 4 or 5% even per week? It's going to be tough. Okay, so that's why take the chance. Now, I say that, but I know some of you have your own research and analysis, of course, and you have a stock that's coming up to earnings that you've studied and you feel strongly it's going to be neutral to bullish. You could take that chance. But just remember, the lie of leverage works both ways. I can get a 20 or 15% return on a weekly diagonal, where a covered call selling the same at the money strike would only give me 0.5 or 0.6% return. What if the stock falls 10%? I'm at a 9% loss. Okay? In the diagonal spread, if the stock gaps down 10%, I'm probably at a 30 or 40% loss. Lie of leverage works both ways. And again, we talked about the technicals. We do want a stock that's trending in an uptrend. If I'm doing weeklies, I'm usually looking for stocks above the 20-day moving average. The average stock volume here, 750,000 shares. And then, of course, we look for the Bollinger Band to be greater than 70 or maybe 75%. and we want to see a crossover, a positive MACD crossover within the last 2 to 3 days. Okay. Now, a subtle sidestep for the power options customers and those of you that are attending. A while ago, Ernie posted his results for bull put, bull call debit, and bear call credit spreads. And he created a screen that he historically tested for weekly spreads. I get this question on a regular basis. An investor comes in who's interested in weekly vertical spreads. They pull up our default search, but they notice that the short option expiration is set to 8 to 17 days out in time. Okay. Well, that reflects, again, the testing. The same thing, why I started out with those fundamentals I did, and then knew I was probably going to add in the MACD and the Bollinger Band range as the technicals to enhance the returns over time, because that's what Ernie reflected in his testing. And it's the same sentiment, okay? So we talked about a weekly structure for diagonal calls or diagonal puts where we're looking for the short option to be 0 to 8 days out in time. But if it's good for the goose, is it good for the gander? Does that work the same with diagonals as well? Yes and no. That 8.6% spread diagonal I mentioned that matched our criteria when applying the MACD and the Bollinger Band was for T-Mobile US, TMUS. And the spread on January 23rd for the 1 week out, selling that 4 or 5 day out call for that Friday's expiration against the 30 to 60 out long call had a 5-day return of 8.6%. The same spread on T-Mobile, 14 days out, so I sold the option that was 2 weeks out and bought an option was similar, had a higher return of 16.5%. Okay, but now there's a double trade-off here. What's the trade-off? The annual return going week by week by week would be higher. But of course this is based on, just as we were talking with Ann, that premium I would have received for the 5-day out might have only been 20 cents or so on the same stock. Whereas the 14-day out call might have been closer to 35 or 40. So it's close to double. What does that mean? That means I'm in a longer time frame of 14 days. There's more time for the stock to maybe move against me. I need more time for the stock to stay in its neutral to semi-bullish position, but I've increased the downside protection if the stock went against me in the first few days because we received more premium. We do receive a higher overall return on the position if everything works out right. But again, annualized it would be lower. It's not twice the return, is it? Okay, that would be at 17.2%, so we're just a little bit below twice. But we initially had a lower debit, had a higher downside protection, meaning a long option could lose more before that. But over a long time horizon, we did see, of course, that the 14-day out did give a slightly better return. Not a lot, believe it or not. Not what Ernie experienced with the bull put credit spreads. It was a factor of about 2 or 3 times. It was about 2 or 3 times better return instead of using 5-day out vertical spreads as opposed to using the 14-day out spreads. Because even with the vertical spreads having the same win-loss ratio on the proper stocks, the net credit on the 7-day is lower, so the losses get compounded faster. On the diagonal spread, it didn't reflect it that much from what I've seen so far in the testing. Okay, but it is a comparison you want to consider. If you want a higher premium, more downside protection and lower debit, there's nothing wrong with going 2 weeks out. You might not get as high as annualized return, but your losses would be monetarily less, and you'd have a higher downside protection. Okay? All right. Now, not everyone's doing weeklies. I know they're the most popular thing out there right now as far as option strategies, whether you're doing straddles or strangles or whether you're doing other positions as well. Everyone likes to do weeklies. You know, I talk about married puts, so can you use weeklies? And I talk about bull puts. Where are the 3-day out and the 2-day out trades? You talk about short straddles or short strangles. Even buying straddles or strangles for earnings, usually the first question that comes up is, can you do this with weeklies? Okay? but not everyone does them. A lot of us still prefer to do the monthly diagonal spreads. I do about half and half. So what would we change if you wanted to do a further out option to get a better premium up front instead of dealing with these 20 cents and 30-cent premiums that you're getting for a 5-day out or 14-day out trade? Well, the fundamentals and the technicals remain the same. The advantage of doing the monthlies is we can create wider spreads. So I can look for my short option, what I change, instead of 0 to 8 days out, the option I'm selling would be between 20 to 30 days out in time. Which means my long option that I'm buying, I still want that minimum of 3 right cycles, so I'm probably going at least 120 or more likely 150 days out in time. This allows me to have a slower time decay. Okay, the option that's further out in time, those first 20 to 30 days, the time decay of the option that's 120, 150 days out, time decay curve, doesn't really kick in until the last 30 to 45 days, assuming everything else stays the same. So if this is 180 days out, and then 150 here, and then 120, and then 90, and then 60, well, if everything stays the same and we're able to sell against it month by month, we're not getting a lot of time decay on that long option until we get in the last 2 months. And hopefully by that time, we've reduced the cost of this well enough that we're looking at a strong leverage profit. I want to follow the same rules for delta ratio and IV ratio. That doesn't change. The only thing that would change are my days out in time. So I'd adjust that to go 20 to 30 days out for the short option I'm selling, and I'd look for a long option at least 150 days out. It also comes down to about 5 or 6 times the amount of time going forward. The other advantage, slight difference that we can use with the monthly diagonals instead of the weekly is that we can go further in the money. Instead of going, maybe 4% in the money, we can go 7% in the money or more, and we can give ourselves more cushion to the upside. We can go further out of the money and still get a reasonable premium. Okay, so that's sort of what we would consider with doing a monthly. Whether you're doing a weekly calendar call, or diagonal call I should say, a weekly diagonal put, or a monthly diagonal call or monthly diagonal put, this underlying criteria will not change. It's the same direction. You want the same thing. You can just change the structure of the spread to better match what you'd want to see as well. Okay, and keep in mind also, and that factor also involved, is that you can still keep the same debit. You might have to give up a little bit of volume when you look for the criteria that are 150 days out in time, for example, as well. But you're going to be able to just change things slightly, okay, when you're doing that. Now, I spent a lot of time and review on neutral to bullish, but we also want to talk about neutral to bearish. If you're interested, but you have more of a bearish sentiment on the market, you're looking more at diagonal puts than you're looking at diagonal calls. Okay? But the option criteria stays the same if you're doing weekly or monthly. You're still going to look 0 to 8 days out in time and maybe 30 to 60 days out for the long option comparatively. You're also going to look for an IV ratio of greater than 1, a delta ratio of greater than 1.6. Okay? But what changes is the fundamentals. In this case, instead of looking for a stock that has a positive earnings per share growth, I look for an earnings per share growth of less than 0. I'm going to take out the PE ratio altogether. I'm not going to worry about it. I still want to look for mid to large cap stocks. Okay, I don't want surprises. See, the small cap stocks, you'd say, oh, well, smaller caps, they can fluctuate more and you can get a good bearish drop, which would be good for a calendar put. That's right, but any change in the news or any change in volume and the stock spikes up, you're going to be at a loss. It's almost not worth taking that chance, in my opinion, with small cap stocks and fly-by-night companies because it could swing in either direction. We'd switch the ideas. Instead of stocks being above the 20-day, we want stocks to be below the SMA 20. I'd want stocks near the lower range of their Bollinger Band, and I'd want stocks where the MACD has crossed below the signal line in maybe the last 2 or 3 days. And again, no earnings. Between now and the short-term expiration, whether you're looking at a weekly diagonal put or a monthly diagonal put, I just don't want to take that chance of me being wrong, the earnings coming out and the stock acting up gapping up this time instead of gapping down, but gapping up 15 or 20%. Now my calendar put, just as before, is at a loss of 30, 40, maybe even 50%, and it's going to be more difficult to manage. So why take the chance in that scenario? All right? So weekly diagonal put criteria, same situation for the options. The short option, 0 to 8 days out in time. The long option, 30 to 60 days out in time. And you can go 14 days out as we discussed. This is just a general view. We want the IV ratio greater than 1. You still want a delta ratio of greater than 1.6. But again, what changes is now we want stocks that have shown negative earnings per share growth, possibly. I want to look at mid to large cap stocks because I don't want fly-by-nights. I want to avoid earnings. I want stocks under their 20-day moving average. I still want stocks with a reasonable volume, again, just to avoid the fly-by-nights. Oops, I'm sorry, but now, that didn't. We want the Bollinger Band to be less than 40 range, and we want that negative MACD crossover as well. And for the monthly, okay, all you change is that short option, go 20 to 30 days. The long option, 150, maybe 120 days out in time or more. Shoot. Thank you, James. There we go. Okay, that's better. Is that better? That's where we were, right? So we were talking about the option criteria remaining the same. We'd switch the fundamental and technical data on the stock to look for earnings per share growth less than 0. Mid to large cap again, stocks above or below the SMA 20, Bollinger Band less than 40, and the MACD crossover. Don't need the earnings surprise. Again, the option criteria, short option, 0 to 8 days out, 30 to 60 for the long, an IV ratio of less than 1 or greater than 1, delta ratio of greater than 1.6. That stays the same. But the EPSG less than 0, still avoid earnings, Bollinger Band of less than 40, so it's nearer to the bottom or at least below the halfway point, the 20-day moving average, which would be reflected. And we want to look for maybe a negative MACD crossover on the position because the underlying has to match the sentiment. We're looking for the neutral to bearish criteria as opposed to the neutral to bullish criteria in this case. And then again, for monthly diagonal puts, nothing wrong with doing that. Change the short option to be between 20 to 30 days. And now the long option, you want maybe 120 to 150 days out in time. You give yourself more ability to create wider spreads, still getting a good net debit and a good percentage return. Okay, I'm going to take a pause for a moment here. I know we're after 1 o'clock. I still want to cover briefly the diagonals a little bit, but if anyone, the horizontals. But if anyone has a question about diagonals, go ahead. I'm going to pause the screen for a moment here. I want to look at something real quick. I'm going to show everyone 2 things here real quick. Let's just go here, okay? So if anyone has any questions, just use the question pod and send that in for now if you have questions about the diagonals. And I'm just going to do this very quickly here. QCOM, I want to take a look there. But let me review one thing very quickly. Okay, so David asks, is this going to be posted? Yes. I am going to post the archive webinar. James says, what is the best time to sell in the short cycle? Okay. My opinion on this is the same as the vertical spreads. If I'm doing a weekly position, okay, excuse me guys, ladies and gentlemen, James, if I'm doing the weekly spread, now here's a weekly spread, for example, on Walt Disney that matches our weekly diagonal where I increased it to 4 to 14 days, okay. Now, if I'm going 4 to 14 days out, I would open this position today. Oh, there we go, I'm sorry. It's just a position on Walt Disney that comes up with our default criteria. Let's go to the profit and loss chart. Walt Disney is at 111.86, I'm sorry. I could sell the March 24th, 113 for 45, buy the 100 at 12.30. It's a reasonable return, 10% return almost for a 14-day trade. But if you're doing closer weeklies, okay, you're looking for today's expiration, you know, if you did the 113, again, you're only getting that 14 or 15 cents. It still might be a good return, but you're not getting as much downside protection. Okay? Keep in mind this would be a good spread. I apologize there, James. In this situation, be a good spread here, but it's a 7% return instead of a 9% return 14 days out. Again, it's not double, okay? But to your question, if I'm doing weeklies, would I open this position today? Well, that's something you have to ask yourself. My opinion is that when I'm in a portfolio of spreads or any other strategy, what you find yourself is getting in the pattern. And what I mean by that is if I held this to Friday expiration, okay, would I close it on Friday? Would I close it on Thursday so I don't have to worry about the break or a gap from Thursday to Friday? No, most likely, just like a covered call, if the stock's not above my short call strike price, I'm holding it to expiration to get this lowest price. I may roll it on Friday, but if I'm opening a new position, by the way, on a stock that I haven't studied that matches my criteria, but I haven't been tracking it, even though I can see the stock chart, I'd probably wait till Monday because I don't want to take any chance of the things happening over the weekend. If I've been tracking Disney for a while, I've been following it, I know its cycle, I might have no problem rolling on Friday and leaving the spread open for the weekend. But when I'm opening a brand new position, I usually go Monday to the expiration. Okay, try not, in general, if I'm doing short-term weeklies, you probably don't want to leave the position over the weekend. If I'm doing a monthly, I'm okay with that because I gave myself a better cushion and a wider range by selling the 20 to 30 day out and buying the option that was 150 days out in time. John says, is there assignment risk on index options? Well, yeah, there is an assignment risk on those types of options in the sense that if you're in a European index where you don't own the downside, you can't be assigned expiration, but if it moves up, you still have to cover the cash settlement. That doesn't change, okay? You can't be early assigned, but not the American style ones, the American style indexes, you can be assigned early. So you got to take that into account as well. But the European styles, no, but if it's above that, you would still have to take the position as well. I'm going to do something very quick here. I know I've been bouncing around behind the screen, but I want to go into a search for married puts real quick, and I just want to change something. I'm going to find something for Ann here, and I know I'm in a married put. It's just easier to set this without changing a whole bunch of criteria. 25 to 30. Let's see what we've got. Okay. Sorry, folks. Take this out as I change more criteria, but let's just go to April. Okay. Close. I'll use Sierra Wireless, maybe. Let's see here. No, that's not going to cut it. Well, it might. Okay, it might. So earlier, and we showed Alta. We showed the ULTA position. It was trading at $286. We looked at essentially the 290 call, okay. I'm sorry, versus the 275, okay. So not the same, but close to similar. The 30 call here is at 0 to 10 cents. So let's say I could actually get 15 cents for it if it was a 29 strike. 1/10 of what we saw with Alta. Stock's at 27.71 instead of 28.61. But let's say we doubled this and we got 20 cents. Okay. Now remember, that would be very high. But now let's go to April, 37 days out. Of course, it doesn't offer 27.50, and that's what I needed. Okay, let me just try something else here. I'm going to use eBay. It's at 32.64, but again, it's 1/10. So let's sell our 2-day out option. And our call, let's go to the 33. So instead of the stock being at 28.61 and selling the 29, stock's at 32.64. We're going to sell the 33. And remember, on Alta, we saw a premium of 30 or 40 cents for a 2-day out of the money option. Here we're seeing 7 cents. Okay. So let's add that back in. We sell this for 7 cents. And then we buy the April 21st. Okay, with the stock at 32, this was at 28.61, so we went to 27.50. So here, we're going to call it about 30 strike. About 3 strikes in. So we'll call it the 30 strike, and we'll put this cost at about 285. Okay. Now, let's let's see, go lower. I don't want to use the 32, that's too close, but the 31. But see here, what we would have seen is a price, if it was just evenly 1/10 amp, this would have been a price of 1430, so we'll call it 143. All right. Now, sorry, there we go. All right. So now you see a higher return in this case, percentage-wise. Monetarily, it's about the same. But remember, we couldn't get anywhere near this price for this position. We would have only received 3 cents against it had we done it. Let's put in the actual price again. We would pay for the 30. It'd be at about 285. Okay, so that debit is much less. But the return is 14%, where we were looking at 20.6 in Alta. So it's a trade-off, and it really is. Okay, you could get a lower net debit by going to the 31 strike here for April instead of the 30, with the stock at 32.64. Good range in the money. But again, the return's probably going to be close, the max return would be closer to 16 or 17%. It's not going to be a lot more. Okay, when you have the proper strike set up and you look at it that direction as well. Okay, all right. So, you know, this just kind of shows you an example here. I know it's not a great one because we couldn't find one real quick with the exact prices, but that's what you might want to think about when doing it. I don't see a problem with trading a diagonal spread or a horizontal spread on eBay or lower price stocks in that range, provided that it matches the sentiment of the spread. If you're neutral to bullish or if you're just neutral in general, and that's what you want to look for. Okay. I wanted to pull up a chart on Qualcomm here, and I'm going to go to a 6-month chart before we get into the horizontals. So here are some of the things that, you know, we're going to review it, but here are some of the things that I would look for in a horizontal spread. We talked about the Bollinger Bands. That's the envelope we're seeing here. Now, in a good uptrend, you know, I'd want a stock to be up near the upper range. This, to me, would look for more a diagonal call position, and if it was down at the bottom, be a diagonal put. Here's our Bollinger Band, there, or I'm sorry, the MACD. There was the recent crossover here, so I'd look for, you know, maybe a position here. It would have come up in my results, and it would have done good for us over that time period. This stock would have been a great stock for a horizontal calendar call or calendar put over a 3-month period. It's bouncing between 65 and 70. If you're using the 67.5, you'd have some management here, but you would have had a reasonable return. This just illustrates why we want to avoid the earnings between now and expiration. I know it's obvious to most of you, but this is an illustration of what we're looking at. Even at this point, the stock would have had the criteria and had the trend that I'd be looking for a horizontal spread, that neutral position, horizontal call, horizontal put. It would have made me a reasonable, strong profit. Even if I was just doing a calendar or a diagonal call or a diagonal put, this would have been a profitable position over this 4-month period. And then once the earnings comes out, the stock drops from 65 down to 55. Okay, it's a 10-point drop, but reflecting, we're looking at closer towards a 17-20% decline, which is going to cause you a loss of about 30 to 50% on the leverage spread. Okay, so that's why we look at avoiding the earnings. I bring this up. This was a conversation I had 3 weeks ago, I believe, with one of the power options customers who was doing diagonals and made a really good profit here on the diagonal, and then was looking at a loss. What he had made here did not make up for the loss he suddenly took because of the earnings. And that's why I don't trade any diagonal or horizontal around earnings, because it's not worth it. Once it's settled here, now maybe I'd consider a diagonal, maybe a 1-week out horizontal once I thought it was stabilized, but that's harder to predict after a big drop like this. So I would have avoided it until maybe I saw that crossover and the stock started to go back up to its upper Bollinger Band. Right about here would have been a good diagonal call. Okay, so that's what we're kind of looking for when we talk about the Bollinger Band ranges, and the MACD as well. I just wanted to show that as an illustration to clear up some of the things we were talking about earlier. And of course, discuss why, when looking at a horizontal spread, you want neutral positions, but you still want to avoid earnings, okay? So what will I look for when looking at a horizontal call or horizontal put spread? I want stocks that are more neutral. I want them to be in a range of that Bollinger Band, and the range I set for what's called the percent BB20 on power options to be between 45 to 65%. I want it to be around 50% between that range. I don't want things that reflect a breakout if possible. I do want lower volatility in this case for the stock. Again, a higher volatility would mean a higher implied volatility in most cases, and although it looks like a better return and a great position because your IV ratio might be greater than 2 or greater than 3, if it has that high volatility because an event coming up or it tends to fluctuate drastically, that's the exact opposite of what you want in a neutral position. In general, when creating a horizontal, you're going to use the at-the-money options. You probably don't want to go more than 1 or 2% in or out of the money. And if I go 3 or 4 strikes in the money on a horizontal call, that's a bearish position. I need the stock to drop 3 or 4% to get the maximum profit. I might be starting off right now at a loss. And reverse, if I go out of the money with the calls, I've created an extremely bullish position where now I need the stock to move up 3 or 4 strikes in order to have the maximum profit on the position. If you have that sentiment that the stock's more bullish or more bearish, you want to focus on the diagonal rather than trying to set the horizontal. The option criteria are going to be the same. Okay, you're going to look for the 0 to 8 days out, 30 to 60 when using weeklies. In general, 20 to 30 days out for a short option if you want to do monthly horizontals, which are a bit more risky. Okay, because remember, if you do a monthly horizontal where the short option is 20 to 30 days out, that's more time for the stock to swing against the neutral position you're looking. You'll have a higher profit. Okay, you'll get a lower debit because you're able to maybe sell depending on which option you buy, but you're getting more premium for selling. But again, it's so much time for the stock to move against that probably 1 or 2% that you don't want the stock to move. Another thing the horizontals offer over the diagonals is you're paying less for the option you're buying because you're using the same strike. So you're not going in the money, you're buying it at the money. So you could increase the minimum returns, look for a 20% downside and look for a 15% return. But again, you want the range in or out of the money. You don't want the short strikes or the strikes of the spread to be more than 1 or 2% in or out of the money, because then you're picking a directional trade. You might as well be doing a diagonal at that point. Now, the debit to strike difference ratio, of course, is thrown out the window in this scenario. The strike difference is 0. A horizontal is the same strike spread, so you can't divide by 0. We can't look for that number, okay? So the delta ratio isn't as much, and both your deltas are going to be around 0.5, 0.55, or 0.45 because you're going right at the money. Now, to help you identify positions that have this on the power option search in the calendar spreads, calendar calls or calendar puts, you can set the debit to strike difference ratio to be greater than 3.99, and it'll show you only spreads that have the same strike. We'll talk about that in a later presentation. But again, thinking of neutral positions, similar criteria as far as the options go. The time frame for the short and the long, IV ratio greater than 1. You can greatly enhance the downside protection and the return, and the premium and liquidity would be up to your personal preference. But again, we're looking for neutral positions. We want a good profit. We want a good leverage profit, but it's not worth taking positions that have an extremely high implied volatility range or implied volatility ratio, because that dictates something coming up that might cause the stock to move, or that the stock has been fluctuating wildly. We still want no earnings. We still probably want to look to mid to large cap stocks to avoid fluctuations and large fluctuations in the underlying. And again, the technicals, instead of looking for stocks that are near the upper Bollinger Band for a diagonal call, or near the lower Bollinger Band, or at least below the 50% range for the diagonal put, you want to be in that range of about 45 to 65, and you want the stock volatility to probably be under 50% or 0.50. You don't want a volatile stock when doing the neutral positions. You might get a better premium up front, but again, it has more of a chance to move against you. Now, why don't I talk about a difference between the horizontal call and the horizontal put? Well, essentially they're parity trades. And we saw that in the previous profit and loss chart we looked at the beginning of the presentation during the review. If I'm neutral on a position, and I think the stock's going to remain in a range of 1 or 2% in the next 8 days, or 14 days, or 20 to 30 days, and I'm setting up a horizontal spread, I'll compare the horizontal call to the horizontal put. And then I'll probably select which one I think is giving me the best bang for the buck, the best monetary return and the best percentage return. Okay? So there's no difference on the stock selection because they're not market sentiment driven. It's not neutral to bullish or neutral to bearish. It's just neutral. Okay? And you may want to screen for both or compare the two side by side for showing which one gives you the best return. But again, I stepped ahead here and I showed Qualcomm earlier. But even a position that can be profitable for diagonal spreads or horizontal spreads over a 4 or 5 month period, if you cross in earnings and the stock drops 20%, you can give back that 3 or 4 months of profit because the lie of leverage works both ways. A 40 or 50% loss on one spread is probably going to wipe out even the leverage gains you've made on at least 6 or 7 positions. Okay, that's the lie of leverage. It works both ways. So why take the chance? Even regardless of your sentiment on the stock going forward and what you think is going to happen, why take the chance in that scenario of playing with the earnings on a very neutral position? If I want to trade earnings, you guys know I'm doing a long straddle or a long strangle based on the presentation we did a few months ago. Okay? All right, so I didn't spend much time on the horizontals because the concepts that we would apply to the horizontals were already covered in a longer discussion for the diagonal calls and a little bit on the diagonal puts. All right, just remember when you're doing a horizontal, the same strike, relative same criteria. If you want to do weeklies, set the short option to be 0 to 8, the long to be 30 to 60 days out in time. Get at least 3 or 4 right cycles in between. Okay? Trading a 5-day out trade, I'd want to be 21 to maybe 27 to maybe 30 days out in time on the long. If I'm going 14 days out, looking for a 2-week out option, I'm closer to the 60-day series, about 5 times the amount of time out, at least to give me 3 or 4 right cycles. Okay? And still want the IV ratio greater than 1, but you can enhance the leverage return because you're paying much less percentage-wise for the at-the-money strike than you would for an in-the-money strike on the diagonal call or the diagonal put. But we still don't want any fly-by-night companies. You still don't want anything that fluctuates wildly. We might want to control volatility a little bit more, and you want it to be in a tighter Bollinger Band range as well. All right, well, we've essentially gone the hour and a half. I only wanted to go an hour and 15, but I knew we'd have a lot of information to cover. You guys are going to receive more information soon. We're going to post the archive presentation later on this afternoon. We'll let you all know when that's available. You're going to see the default structures I talked about available in the calendar call and the calendar put search from today's presentation. I'm going to change and edit some of those ones that we have in there now. That'll happen later this week. And later on, we're going to post some more examples, probably in the blog, on the results of testing the criteria we talked about today as well. Now, as I mentioned, in the next week or two, we'll have our follow-up to this presentation, and we're going to talk about management techniques, the rolling of the diagonal spreads, and the horizontal spreads, I should say, as well, maybe even the reverse diagonals also, and some comparisons there. But between now and then, if you have other questions, remember you can send us an email at any time to support@powerop.com. You can also call us during office hours. We do have a toll-free number if you live inside the U.S., and that's 877-992-7971. And, of course, if you live outside the U.S., you can reach us at 302-992-7971. And those of you that are subscribers, of course, or trial members to Power Options, remember you can schedule one of those coaching sessions at any time that's available as well. On a side note, I'm actually not going to be available on the phone for the next 20 to 30 minutes or so, so if you do call, you might get Greg or you might get Ernie, but if you wanted to talk about today's presentation, unfortunately I'm not going to be available for the next 30 minutes or so. But Greg and Ernie will most likely be able to answer any questions that you have regarding today's presentation or other materials and other questions you might have as well. Well, ladies and gentlemen, thank you for joining me today. I know we covered a lot of numbers and we presented a lot of different concepts and ideas there, and it might take a while to digest this as far as the criteria goes, and what did I say 10 slides ago, and what did I say 15 slides ago? Well, that's why we like to post the archive for you. And I'll let you know when that's available. I hope you all have a fantastic trading day, and we'll see you soon. Good night.